So how are you today?
I'm good.
Come closer to me.
Sorry. I'm good.
There you go.
I've got, a busy day. I got to drive up to Sonoma County and should be interesting,
Gotta drive up to Sonoma County
Yes.
to have a beautiful camping
me.
trip with your
You're
men.
Right. In the redwoods.
Oh.
Right.
The things you have to do. It's a rough life.
It's a tough life, right?
But you're busy, right? Because you're kind of out of commish when you're up there.
Yeah, for sure.
Yeah.
It's always stressful not to be able to be within, like now, years ago we had no phones, no cell phones. Everybody was happy.
How did we
now all of
ever
a
get
sudden
by?
it's like, I can't, a day without being connected.
I think the last place on Earth is like the bottom of the Grand Canyon. I think you still can't get a cell signal down there.
Oh, really?
Last time I was there, which was like 2004, I think, I spent 8 days with no cell signal. And it was, my heart was thumping as I turned my phone back on to see what had happened with work,
Really?
And what had happened in the world.
Wow.
That was
a great trip though, right? I've always wanted to do that.
Oh, yeah. River rafting down the Grand Canyon.
With your family?
I went with my dad, and his father took him. So this is like a generational legacy thing. I'll
You're
take
gonna do it
my.
with your kids?
Oh, sure, yeah,
Oh,
when they're big
man.
enough.
Wow.
And I'll wait till they can appreciate it because then it's an expensive trip. It's a little arduous. Like we did the Cadillac trip. We did not row ourselves down the Grand Canyon. It was 8 days on a pontoon boat where they cooked for us and they did all the steering. It was still phenomenal.
Oh.
And we still had, all kinds of crazy rattlesnake encounters and floods at night, taking out somebody's cot. And
Really?
They slept right next to the river and, they let more water out at night. You don't sleep within, 4 or 5 feet of a river. Hey, this is like anyone who's been out camping near a river should know this by now. Word to the wise, everyone.
Yeah.
So, they let some more water out of Powell at night and whoosh, took out somebody's cot. Luckily, they were not injured.
The guides didn't tell them?
I think they just moved themselves late at night or something. I don't know how they ended up so close to the river. But anyway, if you ever get a chance to do a trip like that, I highly recommend it.
Yeah, I would love to do
phenomenal.
that. I'm sure my kids, we've always talked about it.
Next DMG trip, maybe.
Oh, wouldn't that be great?
All right.
They do them like in a week? Is it a week?
Yeah, you could
have to,
actually
apply, right?
You could
Get a
do
permit?
5 days and then helicopter out of the canyon, which I would do with like a company trip because the last 3 days are pretty boring. There's not a lot of rapids. It's a cool view because you're just in this canyon with sheer walls on either side.
Yeah.
But it's relatively boring. The helicopter ride out, I hear, is phenomenal.
I'll bet.
So I would do 5 days on the river, helicopter yourself out of there.
Let's apply. That would be so
All right,
fun.
yeah, a year in advance at least.
Okay, that would be really cool.
What are we talking about today?
I don't know. Look. We're talking about, this is a big one. It's about the tax proposals.
So it is July of 2021, and Biden has finalized some of his proposals, and the team.
Right. And now they're in the negotiation part in the Senate, as where we are right now. And so there's a couple of competing plans that we want to cover with you. And first, we'll talk about the Biden tax plan. He's been consistent with what he's been talking about since he was running. This first came out, I saw it like in October of last year, and I thought, oh my gosh, if he does this, it's going to be horrible. I thought the markets were going to, crash and everything, and of course they've done the anti-crash, they've gone the opposite direction. So it's been pretty amazing you always think you know what the markets are going to do, and they don't.
It's just a perfect reminder that diversification and staying the course will never steer you wrong.
Yeah.
And the minute you think you know better, well, bam, they'll get you.
Yeah. We probably ought to do our intro, though, right?
Oh, right. Yep. Who are we?
Yeah. Who are we looking at here? Hello, everybody. Welcome to A Place of Possibility podcast. I'm Richard Del Monte.
And I'm Angela Wright. Today we are talking about the 2021 Biden tax proposal.
Yep. So
dig in.
There's.
How are we going to keep people awake while we talk?
I don't know, but it's like we'll keep doing this to you and see if it keeps you awake. So there's a couple changes. It really does impact a lot of people, so it is worth staying awake for.
Yep.
Do you remember Cliff Notes?
Who didn't use them?
We're dishing out lots of great takeaways for you and realize it might be helpful to provide you with our version of Cliff Notes, aka DMG's Know Your Possibilities Guide.
To access the tool, download it, and share it, just head on over to the show notes page on our website for this episode and have fun. Take notes, and if you have questions, getting in touch with us is super easy. Just send an email to info@aplaceofpossibility.com or call 925-736-6410.
Well done.
So here's what's in play so far. So the long-term capital gains tax rates, so that's if you buy or if you sell things, houses, stocks, what else? I mean, businesses, things like that. And those are capital assets. Your car, if you made money on it, no one ever does, but you could. And if you do that and you made a profit, the tax rate on those assets is different than if you go work in your job.
Yeah.
Different tax rate. They've always been preferential taxes, and they've been either 0 or 15% or 20% recently. That's the current law. Mr. Biden is proposing that the tax rate go from 20% maximum up to 43.4% max if on capital gains if your income is above $1 million.
Income above
including
$1 million.
capital gains. So if you made like $400,000 working, let's say, and you made $800,000 on a capital gain, like you sold your house or something, which a lot of people are selling houses right and left right now.
Now this year.
And they're making big money. So that means that the amount of income that you have above $1 million, which in that case would be like $300,000, would be taxed at 43.4%. Not to be outdone though, California wants their piece if you're in this state, and it's going to be another 13%. So you're talking almost 57% tax rate. Yeah. That's a big change.
Huge. I mean, the implications, for our planning, like, we often plan around, okay, well, when you retire, you might sell this business, and the amount of money you'll be able to pull from that, the profit of the sale changes significantly.
Oh, yeah.
When such a big portion of it goes to taxes.
Yeah. Or you're selling your house. You think I'm going to come out and move to, how many people do we talk to every day that want to move to,
Oregon,
Texas, or someplace else?
It's all Oregon right now. Everyone loves Oregon and Idaho. Coeur d'Alene, Idaho.
Some are going to Nevada too.
Oh yeah,
no tax there.
No tax.
Yeah. Right. So those people it's a big change.
If you've been thinking about doing something like that, you might want to do it this year.
It's time. But the one little caveat, and we're going to have lots of caveats here, but one little caveat about that is that the Biden's proposal is effective, I think, April 28th.
Oh, gosh.
So I doubt it'll happen because it's kind of unfair, right?
It is unfair.
But they have
do this
been known
sometimes.
to do that.
Yeah.
They do, right? Yeah. So
well,
it's just something to be aware of.
Hopefully the negotiations, we'll get a Jan 1, 22 start date on that.
So if that happens, how would you cut your capital gains rate? I mean, I think, you could just not do it.
Well, you don't sell the house.
Don't sell it, right?
Rent
it out.
If you could do that, I think it takes a significant amount of capital if you do have to move to buy another house without selling your current home.
Some people would leverage it. They would borrow the money out of the house and then take that and go invest it somewhere else and just leave the house there.
Yeah.
That's one of the strategies one of the things that the Biden administration is very upset about is the wealthy people are taking these pledged asset lines against their accounts and stuff and just borrowing forever. And they know that the interest rate on their money that they're borrowing is growing at a slower rate than their assets are growing. Yeah. So they don't care if the debt goes up in there. Yeah. They just never sell. And that's their strategy to avoid tax. Yeah. And it drives the government crazy.
Wait until you die and give your beneficiaries the step up.
Yeah, or maybe not. If they don't get it, it's like, well, it's too bad, but you're going to get what you get. At least you're getting something you didn't have now.
Yeah.
Another way to do it is to do an installment sale. So like if you sell your house or you sell your business, don't just take all the money in 1 year. You make it a setup where the people that are buying it have to pay you out over 2 years or 3 years. So you could sell it on 12/31 and they give you half on 12/31 and the other half on 1/1. Now all of a sudden, instead of having $1 million of gain, you have two $500,000 chunks. And now your rate is cut in half.
Genius.
Yeah, it's brilliant, right? So those are things you can think about doing.
Yep.
So there'll be more seller financing opportunities in the future for businesses, homes, apartment buildings, all that stuff because the tax rate is low.
Love it.
Lower, yeah.
That's great for, we've been talking a lot about the younger generations really being priced out of the market and not being able to save enough for down payments because their down payments are so huge and they're crippled, they've got their student debt.
Yep.
Seller financing, it really helps the people just getting started and the poor in our society.
Right.
So I like the way that this works for those people.
I agree. And I did a seller finance deal one time where I bought a building from a guy who didn't want to pay the capital gains tax. Mm-hmm. And the way it worked out, I paid him over 20 years. He ended up having no capital gains tax because his 20-year increments were below the threshold where they were taxable.
Brilliant.
So he ended up probably would have paid $200,000 of tax and ended up being nothing.
And did he use that as a retirement income stream?
I'm sure.
Over those 20 years?
Yeah, he did.
Fabulous.
Right? He's making like $5,000 a month for the rest of his life.
That's wonderful.
Yeah, it was pretty good. Okay, the other thing you could do is you can make a charitable deduction, a contribution, all in the year of this big gain, right?
Yeah.
So if you're in the habit of making charitable contributions over time, like you pay tithing to your church, or you make you support organizations.
Got $50 a month going out to Golden Gate Parks on my credit card.
Whatever it is, yeah, or you make bigger numbers, for bigger bequests. You can do what's called a donor advised fund. You can put in a big slug of money, like maybe 10 years worth of your normal contributions in 1 year, and use that big deduction to offset your big capital gain to get you below the $1 million threshold.
So you can write off all of the money that you put into something like a donor advised fund, a charitable fund, in the first year against your income for the year. All that ordinary income.
Up to 30% of your AGI.
There you go.
That's the limit. So it really only helps you if you're, but it helps you no matter what. Even if you're in a high level, it's going to save you 56% tax rate. That's a pretty good deal. But you're not paying anything. You're only paying 44% of out of your pocket of what goes to these charities. So that's pretty powerful. Yeah. Pretty powerful incentive. And donor advised funds are available anywhere. Schwab, Fidelity, I'm sure TD has them.
Sure, yeah. They're really easy to set up and administer. You hear something donor advised fund, you think you have to have your own philanthropy to do that.
No,
not at all. Simple. It's just an account you open,
it's like an IRA almost. In fact, I did it online at Fidelity in about a half an hour. It was done. 5 minutes, and it was set up and it was in there. I transferred the money over into it. It was amazing. Yeah. No, nobody even helped me. Okay. So where it gets a little bit or it kind of diverges into two tracks is in the area of, oh, wait a minute, I missed one.
What'd you miss?
The ordinary income tax rate is going to go to from 37.5% to 39.5%. Yeah. It's not a big deal. It's 2% on the higher end for people above 400,000. So Biden says that we're not going to have any impact on anybody that makes under 400,000 from these tax changes. So we'll see.
That's the majority of the population.
It will hit people on the estate tax thing, though.
Let's talk about estate tax.
Not true, Joe. It's like Mr.
We don't like these estate tax changes.
Yeah, we're not happy about these at all. And I don't think you will be either. So there's two tracks, as I was talking about on the estate side. One is the Biden plan, which has been consistent. It's up for negotiation like anything when it goes through Congress. But then there's also the Bernie Sanders supported one, it's called For the 99.5%. Great name, right? Wow. Who could not support that? Wow. We got to get those 0.5%, those super rich people. But
it's definitely, it is targeting, and I think it opens up a lot of discussions about, what is fair in society, which we will not, this is not the podcast for that. We're going to talk about, rich. And just to set the stage here, we're not commenting on whether or not these are good for society on the whole. We actually sit on two separate sides of the aisle. We have very differing opinions here. And so we are talking about how this impacts investors and our clients specifically. Right. And we don't like you paying more taxes than you have to. So while it might be good for society on the whole, we say we don't like it because, ouch, this is going to hurt.
Hurts our clients. Yeah. For sure. Yeah.
Okay, now let's talk about it. Now we said what needed to be said.
Estate plan. Currently, you're allowed to pass on without any tax at all $11.7 million per decedent to the next generation. So if a married couple can do $23.4 million of an estate to their children tax-free. Pretty big, right? Yeah. It's a big number.
It's nice. We kind of gave up, complicated trust planning for a while.
Who cares?
You don't need that. For the vast majority of people don't need that.
Vast majority. 99.5%.
Oh, yeah. Apparently it's 99.5%.
Are under 23.5 million for sure. So that's called the lifetime exclusion, and that's the amount you can pass on. Anything above that currently gets taxed at 40% flat. That's all. That's it. Mm-hmm. Only for the feds. Some states have a state tax, but in California we don't. I don't know how we don't have that.
I know.
They tax everything else.
Don't tell anyone.
Yeah. Anyway.
Just keep quiet.
Yep. So Biden's proposal is to change the 11.7 million you can pass on tax-free to 1.0 million.
So if I own a house in the Bay Area, womp, 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 I'm paying estate taxes.
Yeah, you could end up paying estate taxes on anything above $1 million.
I mean, I own a 3-bedroom, 1,000 square foot house in Pleasant Hill. And they're going for $1 million now.
Wow, so that's amazing.
Who would have thought I'd have an estate tax problem?
Yep. So that's a big change, right? And that's going to impact a lot of people. Certainly, a lot of people under 400,000 are going to be hit with that because they have real estate, right? Yeah. Where it really gets bad, even worse than that almost, is they want to eliminate the stepped up basis that we get upon death.
Okay, explain what that means, though.
All right. So basically, if you die, say you bought your house for $30,000 in 1970, if you're 85 years old, and now your house is worth $2 million. So you've got, a $1.95 million capital gain, right? If you sold your house, you have to pay that kind of tax on that. You get $500,000 if you're a married couple, tax free, but anything above that, you pay this tax. Well, under the Biden plan, the day you die, that a death is deemed to be a sale, even though you haven't sold it. And so the capital gains tax is due.
To my spouse? Or is this
the
only
government.
passing to my, is this when one of a married couple dies? Or is this the second to die? And now we're talking about the next generation?
It's unclear.
Oh, we don't know yet.
I hope, because it would be shoving an old lady out of the house or an old man. I mean, they can't do that.
Yeah.
So I think it's probably going to be on the second death, but it's going to be deemed a sale. And so the heirs are going to have to come up with, potentially 43.4% federal, 56%, let's say, tax on.
So my mom and dad die and I don't want to sell the house. I have to pay this huge tax in order to keep the house.
Yeah, you're going to have to get a big loan and pay the government. The government, there were some provisions that I've seen where they say you can make this payment over 15 years to them. Lucky you, it's like a mortgage you get to pay because you inherited this money. Where right now you get it free without any tax.
So if you're planning on dying, you could do it this year.
Yeah. George Steinbrenner died when
he
there was
really
no
nailed
tax.
it.
That 1 year.
I love that story.
I love that. Yeah, isn't that great? He was the owner of the Yankees back when. He was a very famous, controversial guy. So, there's that, and so you can end up being hit with the estate tax on anything over $1 million, which the estate tax would be under Biden's plan would be 40% flat, the same as what it is now. And so you get a 40% estate tax hit, and anything left over would be capital gains tax up to 56% on the remainder. So for a California resident, potentially above $1 million, the tax rate could be 75%.
Oh my gosh.
Yeah.
You're losing the bulk of your estate.
You're losing the bulk of your estate. And a lot of people are banking on inheriting money, right? We have how many clients come in and come in? Well, I'm get this money from my parents.
Oh, yeah. That's part of many people's financial plan.
Yeah. And I've had to start having conversations with my kids like, hey, you might think you're going to inherit money from us, but you might get nothing.
Yeah.
You may get a tiny little, a little nice little, handshake with a little check, and that's all.
My folks raised me to say, you're not getting a dime from us. Our last check is going to bounce. So, get your life together.
I love that.
Basically.
Yeah.
I mean, they helped me through college. They didn't kick me out at 18,
right.
But, they made it clear that inheritance is not happening. So anything that does come my way is like frosting on the cake.
But really, inheritance is going to come your way anyway. They still have their house. They still have money.
I hope they spend it.
You do.
Yes, I'm a fully grown adult. I don't need inheritance, and I hope they spend it. And for all of you, 30-year-olds out there, grow up and make your own way in the world. I'm sorry, but counting on your parents' inheritance is not okay.
That doesn't sound very liberal to me.
No, what you need is to get Bezos taxes to pay for your... No, I'm just kidding.
All right, okay.
I think we should cut back those poor kids' debt. That's my personal opinion, but sorry to be harsh with you all, but I really, get off your parents, and
right.
Make your own way in the world.
Yeah, that's another topic.
Because this is like this. If you're counting on your inheritance, and then your parents die like next year before let's say before they fix their estate plan up or something. Any little thing could come along and knock you off track.
Yeah,
one of your parents gets sick and doesn't have a long-term care plan. And then they're paying $10,000 a month, for care. So you're now watching your inheritance dwindle. I mean, just...
And you treat it like it's yours?
Your inheritance is frosting. Unless you're, among some of our families, we have these incredibly wealthy families that we work with and multi-generational planning. And in those families, they're like, you are a steward of these assets by birthright. I think that's a little bit different than, my mom has $500,000 of equity in her home and I'm really banking on inheriting that. Otherwise, I'm not going to be able to retire.
Yeah.
Forget it. Plan your own retirement without them.
And there are some families that cultural
I'm going to step off myself.
No, it's right. I mean, I think that's kind of the American, the American attitude. But there are some cultural families that they treat money as if it's all ours,
Yeah.
I know a guy that was actually, his parents were on vacation in Russia, and he was like cashing out their IRAs and using it as a down payment for their house when they were gone out of the state, out of the country.
But that was like it for their family. That
was totally fine.
Yeah,
it's it's fine. That's what we do. We help each other. So I mean, it's a big country.
Okay, to each their own.
Yeah,
fine.
Exactly. Right. So that's the Biden plan, and you can see that it's very onerous for people that have any kind of significant amount of money. Let's talk about the Bernie Sanders supported for the 99.5% plan, which I'm shocked to say I really agree with better.
I can't believe this. I mean, when we were looking over some of these, we're like,
I agree with Bernie Sanders? Oh my God.
I mean, yeah, a financial advisor agreed with Bernie Sanders. I was like, are you kidding me?
But, right, yeah.
Okay, let's go through some of the details on
All right, so basically the state tax exemption goes from 11.7 million down to, get this, 3.5 million. So it's 3.5 times what Biden's plan is. Bernie Sanders.
Which is more similar to how it's been for the majority of our country's life.
Right.
You can pass some assets.
Yeah, some wealth, but not great wealth.
Yeah.
Right, yeah. So that's basically would be, $7 million for a married couple. It's a lot less onerous. Mm-hmm. It would cover the vast majority of families, like the house, a rental, some IRAs and stuff.
Yeah.
That seems more reasonable to me, especially if they tied it to inflation. I could live with that. Well, you never know. So then that's a good one. That's why I agree with him. But they only are going to allow in that plan $1 million for gifts. So the difference right now, the gifts that you give to your kids while you're alive mm-hmm. are treated the same as inheritance. Mm-hmm. So you can pass on 11.7 million.
Excuse me.
Bless you. To each for each donor while you're alive too.
Yeah.
Dead or alive, it's the same. But under this plan, the 99.5% plan,
is that in addition? So I can give $1 million during my lifetime and then $3.5 million.
I don't know. That's a really good question. I don't know.
That's not so bad.
That would be cool.
Yeah.
Maybe so we can get up to $4 million, 4.5.
Potentially.
Maybe. Yeah. I kind of doubt they're going to let you do that, but maybe they will.
I do like that he has put in effective 1/1/2022. So
yes.
we don't have all this backpedaling.
Right. You're not worried about is it in effect or not. Right.
Excuse me.
Yeah. So January 1st of next year. So you have time to plan with that. You've got the rest of the year to be able to sit down with your estate planning attorney and strategize, which you should be doing.
Those guys are in for a great year.
Yep. Yeah. They're gonna have a banner year, aren't they? Oh my gosh. Yeah. And then afterwards, people figure out what happened. They're gonna have to do it again. So the tax rate, on the other hand, goes very steeply up. So if you have an estate that's worth more than 3.5 million, that's free. Up to 10 million, the tax rate is 45%. Okay. If you go from 10 million to 50 million, the tax rate is 50%. If you go 50 million to $1 billion, 55%, and over $1 billion, 65%.
Ouch.
So Jeff Bezos, all those guys, basically they're saying we're
all the guys in space right now are
the space cadets are all they're going to get their clocks clean. I'm sure
cure world hunger will do it for you by taking your assets when you die.
Yeah, let me tell you, I got a feeling those guys are going to figure out how to work around this thing.
Of course they are.
Don't you think? Yeah, but but they have done some things. They've been very careful about getting rid of the little gotcha things, the little windows. People kind of slip things out. They're closing down things like. IDGITs, which is intentionally defective grantor trusts. Mm-hmm. These other kinds of special trusts.
What about generation skipping? Are we keeping those in place?
Generation skipping is $1 million. That's it.
Oof.
That's a lifetime gift, right?
Wow.
Yeah.
Wow.
Right. So they've basically eliminated any discounts for these little strategies. Like we're transferring a minority interest of our real estate empire, which is worth less now because we can't control it. They're saying no more discounts for minority interest anymore. All those kind of things.
All those cool strategies.
Yeah, we always love those things. As a way to justify.
Although I do think that simplification of our tax code is not a terrible thing in general. It's so complicated. I saw this funny meme the other day that was like it's a conversation between the IRS and a taxpayer. It's like the IRS is like, you owe us money. And then the taxpayer says, well, how much? And then the IRS says, well, we're not going to tell you. And the taxpayer says, so you don't know? And the IRS says, no, we know, but you have to figure it out yourself. And then the taxpayer says, well, what if I get it wrong? And the IRS says, you go to jail. It's so absurd, though, right? Yeah, they know exactly how much we owe.
That is how it is, though.
But it is, yeah. So I think that harms a lot of taxpayers because they don't understand the code and they don't know how to use it. And it's like many people do not need to pay a CPA to file their taxes, but they do because they're afraid they're going to get it wrong.
Right.
I don't hate the idea of simplification, but it is hard for these families that have been using these strategies to have them pulled.
Yeah. I will say that a good CPA probably has a negative cost because he if he's good at knows all the angles and stuff, and he can structure things to be able to save tax.
Yeah.
That's my experience, but you're right. Okay. So, annual gifts, which we all know right now that you can give $15,000 per donee, in other words, per recipient per year, and there's no limit. So if you have 5 kids like I do, you can give each kid $15,000. This is not a promise, kids. $15,000 per year.
Remember what I just said.
Yeah, right. Yeah, you're on your own. $15,000 per kid per year, and then you could give $15,000 to their spouses. You can give $15,000 to their children, your nephews, your nieces, your whatever, your housekeeper, and then your spouse could do the same thing. So there's a lot of money you can clean out of your estate every year, tax free. But that's going to change. It could be, if you try to do any of those little tricky gotcha things like those estate planning vehicles and things where the donees can't actually get their hands on the money right now.
Oh yeah.
Then the maximum you can give in a year is $30,000 total, no matter how many donees there are.
Oh, interesting.
Yeah. So,
but what if they can access it, right? Like,
if they can access it, then
you're good to go.
This 99%.
That's where
plan.
the cruts are going to break apart.
Yeah. They want it to be like, if you're going to give a gift, make it a gift.
Yeah. Where
the people can use it, and then we'll let you do it. So that it's still there, but there's no little strings you can attach.
You're giving the kids the money, they're getting it.
Yeah, right.
No, like I said the word crut. Like that's like a charitable remainder trust where you're giving money to charity, and then your kids get some, afterwards, or or in some cases you're using it during your life, and then it goes to charity afterwards, and it's like. Some of that's getting a little.
Or, like another common one is you're putting money into an irrevocable life insurance trust to pay the premiums on your life insurance. Mm-hmm. You can set that up with something called a crummy letter that actually makes that a gift of present interest to the kids right now. And you write a little letter and say, I'm giving it to you, but you have 30 days to claim it. And if you don't claim it, you don't get it anymore. That probably would go away.
Yeah.
So, because they don't have the permanent access. Maybe they do because 30 days, I don't know, but that might go away. And so it might really kind of wipe out the eyelets. Could be. Okay. So then, so what do you do? Oh, importantly with the
Sanders. Yeah. He leaves out.
Sanders plan. He leaves out what?
That the elimination of the step up in basis.
Oh my gosh. That's
upon
amazing.
Death.
Bernie Sanders takes that out.
I love it.
Yeah. I mean, that's why I'm in favor of this plan. If we have to go do something onerous like this, at least don't take away the stepped up basis. That just seems outrageous.
Yeah.
So the tax rate would be more like, you get basically if you leave $7 million estate to your kids, if you're married, you get that tax free. Anything above that is going to be 40% up to $10 million. That's fairer. I even think it's okay.
Well,
yeah.
I mean, our opinions don't matter. We're sharing the news.
Yeah. I mean, I guess given the options of going with the Biden plan, like,
it's the best hard pill to swallow, I think.
Yeah, right.
Yeah.
Yeah, they're not having to jam it down your throat.
Yeah.
Okay, so what do we do?
Oh, boy.
What's the planning takeaways here?
Yeah, I mean, this is hard because, first of all, we don't even know what's going to get implemented. So you don't want to rush out and completely redo your estate plan based on Biden's proposal, and then that, doesn't get applied as written.
Or it gets applied retroactively.
I mean, then you lost your chance, gosh.
Yeah, right.
Okay, so what can we do?
Well, what we can do is make annual gifts right now. Biden has not touched that in his plan. So $15,000 per donee, as much as you want, and you can. Those are good things you can do.
We have in your book, Endless Inheritance, you talk about this, right? Because this is a common strategy for getting money out of your estate. Just start gifting it to the kids, But I think there's a missed opportunity that we should just touch on briefly here, and that is to mentor your children in the use of this money.
Yeah,
right.
I agree.
Don't just hand them the money and let them run off and have fun with it. I mean, do if you want, I guess. But here's a way to maximize the benefits while you're giving the money away. And that is so some families they'll give the money, and then each year the kid has to write up a little plan of what they're going to do with the money. And then the parent will, or a lot of times it's a grandparent, will mentor them through the use of that money, or they have to I'm using it for school or what have you, or they'll invest it together and they'll talk about it. And so just don't forget that if you're giving your children money, there's an opportunity to teach them about money or about philanthropy while you're doing it.
Right. I think that's a brilliant idea that was done by a famous industrialist, one of the earliest venture capitalists in the 1850s. did exactly what you said with his nieces.
Really?
No kids. He only had nieces and nephews. He did just what you said to do. He asked them what they were going to do. And then after they did it, after he gave them the money, he asked them, what'd you do?
Yeah.
What'd you learn? And by the end of his life, he decided they were all trained up, and he felt free to give them his whole fortune.
Imagine if you could know that your kids aren't going to squander your money by teaching them through the years and using these gifts to do it.
Yep. That's a great idea. And people should not miss that opportunity.
So either pick up Endless Inheritance, folks, if you haven't read it yet.
And she says it's my book, but she helped write it too. So anyway.
It's a really good book.
Yeah.
If we do say so ourselves.
Yeah. No self-serving interest here. Okay, so
do your gifts. All right,
the other thing you can do is you can take advantage of the $11.7 million right now under the current laws. So if you have a larger estate, it could make sense to go see your attorney and do some things right now where you can actually take advantage of these using structures and trusts and things that will pass muster under the Biden plan, or maybe will be grandfathered. He won't reverse their benefits.
Or using your exemption to get, if you trust your kids, get the assets out of your estate today.
Just give it to them, right now. Yeah.
We have a family that has some real estate, like commercial property. They have an LLC, and the parents are thinking about turning the LLC over to the children with sort of a private agreement that, the parents are still getting paid.
Yeah.
Figuring out how to get the parents paid. That's their retirement income. Yeah. But then the kids own all the property and it's all out of the estate. It's perfect.
Yep. So I think this is a really good opportunity. Or the other strategy is just wait out the administration. If you're younger, you might just say, we're going to play the odds and hope that I can outlast the next 8 years, and maybe a Republican administration will come in and undo all this.
I mean, I have a 2-decade career. This has changed 5 times or so in my career. It constantly changes. So if you're young, you're healthy, do your estate planning. Do not ignore it, but know that this will probably change before you die if you're under the age of 80.
Yeah. When I first started in 85, they created this under ERTA, Economic Recovery Tax Act. They created.
You remember the name?
Yeah, I had to study it. My CFP, my MBA class. But they actually. Yeah, you think I can't remember things, right? I don't know.
I'm always giving.
Old people
don't you remember talking about that?
Yeah, I didn't remember things from 30 years ago.
Just random fact from 1982 that you remember. But what did you have for dinner last night?
Yeah, right. Yeah, I remember it well. Let me think.
Okay, anyway, what was the provision?
Well, it was basically they let you have $600,000 tax free. And it was like, what? That's crazy. $600,000. So it was $1.2 million per couple. And it was that way for years and years. Yeah. And it would seem like it was totally phenomenal. And now people are like, Biden wants to do $1 million. Like, what? That's absurd. That's outrageous. So we it's kind of all relative based on what our experience has been. Yeah. So anyway, the other thing you could do is consider doing an irrevocable life insurance trust. Now, I don't want you to...
I get choked on that.
Because
we bag on life insurance all the time.
This involves life insurance, which the last several podcasts you've heard her saying, don't do life insurance. There are some situations where the only option you can have to be able to cut your estate tax is to buy life insurance and have it be outside of your estate.
Yeah. And the way that this works is you're basically taking a huge chunk of your estate today and you're using it as a life insurance premium. You're buying a gigantic policy with it. So you're like, maybe you have $500,000 and you're buying a $10 million policy, something like that. When you put money into an irrevocable trust, it's no longer yours. It goes out of your estate, off the calculation.
Right.
And then the policy pays a significant amount more back to your family tax-free. Life insurance comes to you outside of the estate tax.
Right.
So you're using the insurance to make up the difference of what will inevitably get taxed. And sometimes you're just getting the money out of your estate and then your heirs get it back in the form of an insurance payment.
Right.
So this is a useful tool in high estate tax scenarios.
Right.
Otherwise, we hate life insurance. It's good for covering somebody for income needs when you die. When we say we hate life insurance, it's when you're using it as an investment vehicle. Yeah. It's not productive.
And being sold for everything, everything under the sun. It solves every problem.
It's a useful tool.
Right. But the thing about it is if you're making the premium payments yourself, and it's coming out of your estate, then the IRS could say, oh, no, that's not really outside of your estate because you paid for it with your own estate money. We're going to claw that back into the estate. Can you imagine paying 65% tax or whatever, 40 to 65% tax on the...
Whose plan is that? Is that Biden's plan that wants to claw?
Biden is 40. And Sanders, the 99.5% one, 99.5%, I'm not is up to 65. Oof. So you're basically, if you did that and you weren't careful and that money got clawed back into your estate, you're basically paying premiums on insurance. On insurance that's going to be, most of it's going to go to the government.
If you're going to do that, you
don't
need
want
a good
to do
attorney and a good insurance.
Yeah, get a good attorney to set up an ILIT, irrevocable life insurance trust that will survive these tax regimes that are coming on, or have your kids buy it.
Yeah.
You know, you can make annual gifts to the kids. They can use it to pay the premiums. Exactly. And it's out, not even that way was legit. Yeah. There's no issues with state tax, but they could cash it out and not do it. That's the downside if you don't trust them. Yeah. Gotcha. Woo. Yeah.
This is a fun one today.
Yeah, right. It's really a downer. Ugh. Are you awake? Are you still awake? Yeah.
Yeah, they're terrified. They're shaking in their boots.
I know, right? You know, well, I mean, I would write my congressman or my senator and complain about this because some of these things are really bad. I think it's unfair. We pay tax our whole life. They're going to get it on the other side too. I mean, I just think
this is some
dipping. Right. Yeah.
This is personal opinion time.
Yeah, right. I know, right. Okay.
Oh, wow.
Well, we don't really have any
on that happy note. Yeah, I mean, there aren't any at this point.
Right.
We'll see. You know, we'll keep you updated. If you follow our social media, every time there's a change or something is implemented, we talk about it there. So if you want the most up-to-date information, head over to, we have Facebook, we have an Instagram account now, we're on LinkedIn. Yep. And so if you just type our name in your Google browser, you'll find something.
Or email us at info@placeofpossibility.com.
Yeah, we'd love to hear from you.
Yep. Okay.
Well, thanks for listening, everyone.
Thank you. We'll see you next time.
Have fun this weekend on your trip.
Thank you. I will. I appreciate it. Yeah. Take care, everybody. See you soon.
Bye.
Bye-bye.